This is InvestTalk, independent thinking, shared success.
Hi, Jay from New York. I'm curious what your thoughts are on CMG, Chipotle Mexican Grill. Recently hit a 52-week low, but has otherwise been performing pretty well. Looking for a mid to long-term hold. Curious to see what your thoughts are. I'll listen on the podcast. Thanks.
All right, looking at Chipotle Mexican Grill, and you're right, this is down well off its highs. Its highs were up around $70 per share, and now we're at 41, off 37% from its 52-week high. And, this is a name that was growing in the mid-teens for a while on top line revenue, and earnings last year were up 24%, the previous year 36%, so nice operating leverage there. The problem is that now that's slowed. Last quarter revenue growth was only 3%, earnings were down 3%. And then the question is, what type of multiple do you want to pay for a company that was trading at 50 plus times earnings? Now it's at about 36, even forward looking, you're talking around 30. That is pretty expensive. So the issue is going to be the valuation is what is a reasonable number, and can they return to some decent level of growth? Earnings this year are supposed to be up 8%, 17% next year, but analysts keep downgrading those earnings as well. So let me give you a price here of major support. So the next support level's around 37. I think that is actually a pretty good level. So we're getting there. We're at 41 now. Another 10% lower would be reasonable. Big support really is at 30. So between 30 and 37, I know it's kind of a wide range. Those are the major support levels. So I like Chipotle over the long term. It's very profitable, good balance sheet, no dividend, but they have a proven formula. And when the economy weakens, people lay out less. And I know Chipotle has been raising their prices over time. So they kind of got to a point where now their growth is stalling out. Maybe they're oversaturated, et cetera. And this happens with popular restaurant chains. So I don't think Chipotle is going anywhere. I think you're right to be looking at this for a discount. I just think there's a little more room for the downside for this to go. 37 is my base case, but very well could head down to the $30 level. That was Chipotle Mexican Grill. CMG is the symbol. Now, every day we receive questions from the comment section of the InvestTalk YouTube channel. And this one came in earlier. SSJ says, "Hi, Justin. What are your thoughts on AbbVie? ABBV is a symbol. Do you think I should hold on for the near-term healthcare rally, or is it overpriced and should I exit?" Interesting. Let me pull this up here. Sorry about that. AbbVie. So AbbVie is a very large pharma name, $350 billion market cap. They bought Allergan some years back, and that had been a good acquisition for them. They do have a lot of debt, though, and that is the biggest worry when you have patent issues and patent cliffs, and they do have some problems with that going forward. So there is some worry there. You have earnings up 19% this year and 18% next year. But the estimates for this year are coming down. But that's still pretty strong growth, 14 times earnings of about a $200 stock. Not too bad, right? You're talking a low teens multiple. The relative strength is solid 56. Not amazing, but not terrible. And the chart is still in an uptrend. You're making still a series of, on the weekly chart, higher highs and higher lows. And overall, I think it's fine. I don't like the debt level, but cash flows are fine. Earnings are fine. That dividend looks to be sustainable. So I have no problem holding AbbVie, maybe picking it up. Like I said, it is certainly outperforming the broader healthcare space and is above all the major moving averages. So I'm going to give AbbVie a thumbs up. Now let's roll into another listener question.
Trying to call you guys about ticker symbol LECO. This is Andrew from Atlanta. If you could look at the company's name is Lincoln Electric Holdings Incorporated. Was curious your analysis, if you could let me know. We really like the show. Thank you.
Appreciate the kind words. Looking at Lincoln Electric. They're out of Cleveland, Ohio. This is interesting because I have a I have a good friend who's from Cleveland, doesn't live there anymore, lives here in Southern California, but his parents, his father, I think currently works at Lincoln Electric or retired from Lincoln Electric. But this is a name that it's not very big, $13 billion market cap, but it's been a consistent grower over the years. 2018, they made $4.82. This year, they're supposed to make $9.67, then $10.64 next year. Nice little dividend. It's on an uptrend. I have no issue. It's a bit overbought near term, so it's not necessarily the best time to fire on it. But based on forward-looking earnings, about a 22, 23 times forward-looking earnings, and you get decent growth. And this is in the industrial space. So they make welding power feeding systems for metal fabrication, construction, and other industries. And obviously, if more and more companies are thinking about reshoring manufacturing, which I think will happen at the margins, and you have reindustrialization, you have a modernization of the electric grid, you have more demand for AI data centers, this all takes metal fabrication. And so that's why their earnings remain solid. Analysts continue to upgrade earnings for this year and next year. So I like the name. Strong return on equity, 40%, strong balance sheet. So I'm going to give Lincoln Electric a thumbs up. For more insights and resources, visit us at investtalk.com. Now let's go to a live call. Richard in Santa Clarita wants to talk about strategy in case of a recession.
Yeah, hi, Justin. Thanks for taking my call. I'm a longtime listener, and I might make a few quotes I heard, Steve say, and some things you've said as well. But in terms of preparation or portfolio preparation, I should say, for a possible recession, upcoming recession, or at least a very strong pullback. First of all, I know that Steve always said you never, you might sell, do some trimming, take profits off the table. You never get out of the market because you never know, what's going to really happen. No forecaster, knows for sure. But one of the things to do, I would think, would be to set up, some dry powder, cash. I remember during the recession, during the COVID recession, the short one, it was cash is king was the thing that was being said so much. So my question would be, what do you think of the chances at this stage of a very strong pullback recession? And if so, what percent of a portfolio should you have in cash that's ready to go? Because when the market, the market usually goes up, it takes the stairs. When it comes down, though, sometimes it can take the elevator. With that percentage, I'm thinking maybe 10% to 15% would be something, and you can put that in a money market also, or at least collect some interest. What percent would you say given what's going on right now? What do you think in terms of this current environment, which you should hold in cash?
Yeah, well, I think if we are going into a recession, which I do think there's an increasing likelihood that we will be in a recession sometime next year. I don't think it'll happen this year, but I do think next year is an increasing possibility. But how much cash you should have is definitely dependent on the person, the risk tolerance level, the goals for the money. How long term is it? How short term is that account? If you're needing that money in the near term, then obviously you want to have much higher levels in cash than 10 or 15%. If it's long-term money, 10, 15, 20% is not an issue. But I think it has more to do with your asset allocation, because you really want to be in sectors that can continue to do well. There are certainly companies and broader sectors that can buck the trend, and you want to be in the stocks that are remaining in relatively good trends, right? Uptrends, at least neutral and kind of trading water during times when there's more pressure on the market. And so you can do things like that. You could buy puts, you could sell covered calls. That's a way to lower the risk of a portfolio. That's something to certainly consider. And remember, a lot of people think that a recession is 08. A recession is not always 08. Now, there can be pockets that are greatly affected, that go down considerably. I think of the recession before that. I think of COVID recession, that's kind of a one-off, kind of a unique scenario, because it technically was a recession with shutting down the economy. But I kind of throw that one out, But if you look at like the 2000, 2003 recession, you had technology stocks go down dramatically. So you could have something like that where multiples contract considerably and growth slows in certain pockets of the market. But if you look at that period, the NASDAQ went down 70 or 80%, but the S&P only went down about 20%, 25%, I think it was, from peak to trough, which means that there's pockets in there that were fine, that didn't really go down much at all, and many continued to go up. So I think it's more about a shift in your sector allocation and being overweight the non-cyclical sectors, utilities, consumer staples, it's maybe REITs, things like that, and having a shift towards that. And obviously, once again, there's still pockets of demand for maybe AI data centers, even though you might be in a recession, right? And there can be companies that continue to do well. So I don't think it's just cash. It's not just about that. That can be part of it, but it's about staying in the right companies and sectors that are still outperforming, that have good relative strength, etc. So I love your question, but also adjust your understanding of what a recession means for the market.
Mm-hmm. Okay. All right. Well, thank you very much.
Thanks for the call. Let's go with another YouTube comment section question. Randy, 23, says, great analysis as always. What are your thoughts on AppLovin looking to add as a long-term hold? APP, this is a name that, one of those growthier names. Everyone got excited about it. Earnings were up 288% in 2023, 362% last year to $4.53. And it's supposed to be up 98% this year to $8.95 at 66 times earnings. Okay, and this is a mobile app ecosystem for helping app developers to market, monetize, analyze, and publish their apps. So that's certainly always in demand. That's a good thing. But you're paying a very, very high multiple for that level of growth. Okay, so you have free cash flow about $2.8 billion. So that's positive. They're cash flow positive. They have no debt, really no net debt on their balance sheet. But if you look at their price sales ratio, 30 times, very, very expensive. Enterprise value to EBITDA, 50 times. Now, if they continue to grow that EBITDA, obviously you can grow into that level of a multiple, right? $13 in earnings is expected next year. And if that is true, then actually relatively, I wouldn't say cheap, but not that bad. You're talking, what's that, 30-ish times? 40 times earnings? That's high, but it's not egregious. Let me take a look at the chart here. Yeah, it's certainly overbought near term. I would be interested to see, it had that big reversal back in March, and it hasn't really taken that out. Until it takes off that high, this is actually a modestly bearish chart, medium term. So with a very high multiple. So I don't love the risk versus reward here. I'd have to also dig into that and feel very confident they're going to hit that $13 in earnings next year. Because they only had $4.53 last year and they made 98 cents the year before. I really need to understand, I haven't looked deeply at this name, to be frank, of what's driving that. Remember, these growth names, if they could come out with earnings for this quarter, which are expected to be up 83% and revenues up 11%. And they could hit those numbers, and the stock could still go down dramatically because the market, frankly, was pricing it even better, right? A beat. So, and that when that happens, and you can see this as of late, there's been in this earnings season, there's been a litany of growth companies that have disappointed, and many of them gone down 30, 20, 30, 40% in one day, right, on that earnings. So these are those type of names that will do that. I don't love the chart, and I don't know enough about the business for me to be confident to buy it at these levels. Thanks for the call. Let's talk about the jobs number. And we know that there was a sharp downgrade in the number of jobs that were created over the past few months. And most people assume that is a drop in demand. But there is an argument for the fact that it's actually a drop in labor supply. Okay. And the difference and the cause is very important, because if you get a rate cut, and this drop in job creation was more because of a drop in supply than a drop in demand, it would actually be counterproductive to do a rate cut, because it would actually stimulate more demand, not really create more jobs because you don't have the labor supply, and you would create more labor inflation. Now, we know this administration has a stricter policy when it comes to immigration. And whether you like that policy or not is irrelevant, right? The market only cares about the income of the broader economy, right? It takes income to pay for goods and services. You need income. The way to get income is to have a job, right? And it's about aggregate income in the economy. Okay. And so whether it's drop in demand or drop in supply of labor is somewhat irrelevant to total spending, total economic activity in the economy. Okay. Doesn't matter the result of the drop or the causes of the job losses or lack of job gains, shall we say. Now, the number and the reason for the argument that this is more labor supply is actually hours worked. So the number of total hours worked is the number of people employed multiplied by the average work week. And they have surveys to, right, figure this out. And what's interesting is basically since the beginning of 2024, the beginning of last year, the number of hours worked started to rise and is growing at about a 1.2, 1.3% annualized clip. That's up from basically flat year over year in 2024, beginning of 2024. And the fall in job creation mirrors the decline in immigration inflows. Not just for the period going back to the middle of last year up until now, but actually previous periods as well. So there's clearly a correlation, not a one-for-one correlation, but there's a correlation. Now, the Fed's Michelle Bowman, she actually does not think it is that. And what she looks at is what is called the employment to population ratio. And that's been in decline since 2024. So it's showing something else, even though the average hours worked is rising. The ratio of population to employment has continued to decline. Now, historically, you get a decline in the average hours worked before you get layoffs, right? And I think the best argument against the fact that it's a labor supply issue and that is the fact that this is not really a layoff issue. If you look at initial jobless claims, people aren't really getting laid off at a dramatic pace. It's really hirings that are falling off a cliff. Now, once again, is that people are scared of what happened during COVID and losing good workers, and they're just not laying very many people off. I think there's certainly some scars there. And that's majority of companies probably. But then there's a lot of companies, especially because of tariffs, uncertainty around tariffs, that are just pausing. They're just saying, I don't know what my margins are going to be going forward, so I'm not going to add a lot of additional workers. I'm going to try to do more with less. Maybe utilize AI, for example, and just hire less. So I think the answer here is a little bit of both. I do think that there is a drop in labor demand, but clearly the immigration side is having an impact as well. The pool of labor is shrinking. And that can be a problem for some industries that maybe can't source the right amount of labor to do what they need to do. And so maybe they don't hire additional workers on top of that, right? Maybe Americans that are citizens. If you're trying to open a hotel and you need workers for the kitchen and for housekeeping, etc., you might have trouble sourcing those workers. So you're not hiring front desk people, salespeople for the front and for catering and things like that. And so this is the reality on the ground in the labor market, that it is both a demand problem for new jobs as well as a fall in labor supply.
Join our community of savvy investors. Subscribe to the KPP Premium newsletter for expert analysis and stock ideas.
Now let's look at what is going on in the restaurant industry. We had the call earlier about Chipotle Mexican Grill, so let's expand that out and see what the companies are saying, what that means for the broader economy. So if you look at Dine Brands, they own IHOP and AppLovin. You look at Sweetgreens, Wendy's, Denny's, and Chipotle. They all warned investors recently over this earnings season that consumers are hesitant to spend, and it's hurting their sales. Now, Americans ate 1 billion fewer meals at restaurants between January through March than the same period a year ago. So Q1 24 to Q1 25. And it's mainly at fast food restaurants. Fast food visits from low-income consumers fell industry-wide, double digits between April and June. Why? Because their real incomes declined. Inflation outpaced the growth of the income for low-income consumers. Now, part of this is a slowing labor market due to the tariff regime, scourging spending. And Denny's CEO called it a very choppy consumer environment. Overall visits to U.S. restaurants fell 1% this year so far compared to 2024 over the same period. And once again, fast food restaurants have been hurt the most. They're down 2.3% in the second quarter compared to the second quarter of last year. Now, when Americans did eat out, they were actually cutting back on things like beverages and appetizers and trading down to more inexpensive menu items to lower their overall bill. This is according to the CEO of Dine Brands, Applebee's, IHOP, etc. Why is this? Why is this happening? Like I said, it's the income side, but it's also overall inflation of eating out. Overall food inflation has slowed, but the cost of eating out is outpacing eating at home. The CPI for food at home up 2.4% year over year, currently 2.4%. Food away from home, though, up 3.8% in the trailing 12 months ending in June. So this is a macro story here. You're starting to see the signs pile up, and that's why I am increasingly believing we are going into a recession next year. Now, can a series of rate cuts by the Fed stave that off for a while? I do think that is possible. But usually when that happens, you're at the end of the cycle. it just extends the cycle a little bit, weakening the dollar, steepening the yield curve. That encourages banks to lend more. And that can, once again, keep things going for a little bit longer. But what's happening in the restaurant space as well as Vegas? Now, one of the big factors with Vegas slowing so dramatically as of late, I talked about that, I think, last week, is certainly the immigration side. But it's also the average consumer is a bit tapped out. And you're seeing that in the restaurant indicators. Remember, going to Vegas is it's a luxury. You don't need to do it. And the costs there have certainly gone up. But that travel factor, the fact that 30% of Vegas travelers come from Canada, and Canada's kind of boycotting moving or visiting the United States, that feeds on itself, right? Because that hurts the travel industry, which is a substantial industry in this country. And so it's multiple factors here that are kind of adding up. And you're seeing the signs and the signposts more and more often. And the macro environment and the consumer, especially on the low end, continues to struggle. And this is another sign that a recession is more and more likely in 2026. Now, I'm Justin Klein. This completes another InvestTalk program. And if today's show made you think about your own financial picture in any way, how your portfolio will handle a recession, how your overall retirement plan could handle a recession, I encourage you to head over to investtalk.com and click on the portfolio review button and schedule a no-cost portfolio review with myself or Luke to bring clarity and confidence to your overall plan. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes or Spotify, and watch our videos or post your question over on the YouTube channel as well. Independent thinking, shared success. This is InvestTalk. Good night.